All right, I've got 701. Reed, can you hear me?
Yes, I can. I can hear you loud and clear. Can you hear me?
Awesome. I can hear you. Well, I think let's go ahead and get started. I want to be respectful of people's time. So appreciate you guys joining us on a what in Austin is a rainy and cold day. We're excited to have you here and appreciate your interest at Hawthorne at the district. For those that don't know me, my name is Andrew Campbell, one of the co-founders of Wildhorn. And we are super excited about this opportunity for an off-market deal in Austin, and excited to bring it and share it with you guys tonight. Our aim for the next hour or so is to give everybody a chance to hear from us about the opportunity. Kind of a little bit about who we are, and really kind of the three legs of the stool that at least I look at when I'm making investments, and I want to know who the team is and what they're all about. So I'll tell you a little bit about us as Wildhorn if you're not familiar, the market and what's happening in Austin and the specific submarket. And the last piece is kind of the deal itself. And so we'll walk through the business plan and what our comps look like, and walk through those pieces, financial analysis. And at the end of this, we want to make sure we open up for some questions. And if you have specific things you're curious about, want to make sure we can get those answered. To handle the questions, and because we expect quite a number of people on the call, looks like a lot of people are joining still as we go. We're going to handle that via email. I think as we get this presentation going, it's pretty tough for us to sometimes look through all the chat and whatever has happening here. So if you do have questions, if you'd email those to me, Andrew at wildhorncap.com, we will address those at the end of this call. So we will dive in, and I guess I'll set the stage for kind of who you'll hear from tonight. Obviously, you hear from me, and I'm going to talk through the high level of the deal and kind of introduce our team. You're going to hear from Cooper Drenner, who is a new joining our team for this deal on the GP side, and like myself, is a native Austinite, somebody that we've been consulting with or having him consult with us for a while, as we continue to kind of look for deals just like this, sort of diamond in the rough in Austin. I'll let him cover his background a little bit more specifically in his bio, but he's got a long history of kind of commercial real estate and economic development board in Austin. It's been a big asset to us. So excited to have him on this team, and excited for you guys to get to hear his thoughts on what's happening in Austin at large, and specifically in the submarket. And then we'll have you'll hear from Reed Goosens, another co-founder, kind of walk through the financial analysis and some of the return profiles. So with that, I want to jump right in and kind of start with the first leg of the stool, as I kind of think about it. And that's really kind of spending a couple minutes talking about Wildhorn and who we are. I know there's a lot of repeat investors and return investors here, and certainly appreciate you guys and the continued confidence that you place with us. But for anybody that we're just have met recently, or you haven't kind of heard about who we are, I think it's important. So we'll spend a couple minutes here. At our core, we are a sort of boutique multifamily value add group based in Austin. This will be our 8th deal, and it give us about 1,800 units, and they all very much look and feel like Hawthorne at the district. Our focus geographically is Austin and San Antonio. I think I've got the good fortune of having grown up in Austin and being located in what I think is the best investment market in the country in Central Texas. And we're very, very much focused on finding good risk-adjusted deals in those markets. I think our kind of core investment thesis is we want to be in Class B or better areas and be buying Class B or better assets. I think we've got two rules that we sort of live by at Wildhorn, Reed and I do. And the first is we don't want to go to jail. So we're very strict with our compliance procedures and make sure we're doing everything by the book with the SEC, registering the investments. And I sort of joke with that, but we take that very seriously. And the second piece is we don't want to lose people's money, and I think that drives a lot of the types of deals we look for. One of the reasons we don't look at some of the C-class deals, feel like there's just extra risk there that is you might get a good return, but to us it's a little bit, it adds risk to the deal. We don't want to be buying in tertiary markets where we think there's not as much population growth. So we are. Our job and our goal is to consistently hit singles and doubles, and be buying in great areas that are good areas today. If and when there's a slowdown in the economy, it's still going to be a good, desirable area. And again, I think Hawthorne very much fits that investment thesis. By way of background, I mentioned I grew up in Austin. I've got a marketing and advertising degree, and at Wildhorn, my job is to focus on finding the best deals, making sure we see everything that is on market, off market, somebody's thinking about selling someday. This is a pretty good example of that. And then I handle kind of investor relations. So once we do close on this, you'll hear from me on a monthly basis. Get our take on what's happening, how the property's performing. Reed, his background is structural engineering. He's done a bunch of ground up multifamily development in his past and done some cool projects all over the world. But as a engineer, brings a details focus that's needed as a construction background, and he manages and runs our kind of asset management division as well as our analysts and our underwriting, and brings that kind of construction management discipline. And so that's kind of our core team. I know that there's other members of our GP that some of you may have seen this deal through, and just in the interest of time, don't have the ability for everybody to jump on the call. But a deal this size, it definitely takes a full team to put together, and grateful for all those members as well. So that's kind of who we are and a little bit about us. I guess the two other members of the team I want to mention, because they're very relevant to this deal. The first is our general contractor. I mentioned that Reed is kind of heads up our asset management piece. He also does our construction management, given his background. That's something that we handle in-house, and leverage a really good relationship with a third-party general contractor called THD. We've got a long history with them and are excited to be working with them on this deal, and kind of executing a very similar program that we've done successfully in the past. And the final piece of the team is Roscoe Property Management. They are a third-party management group. They're based in Austin. The majority of their 30,000 units are in Texas, the vast majority, and their biggest concentration is probably Austin. I think more than any other deal we have, they're probably the biggest asset at Hawthorne, just because they are so entrenched in this submarket. They actually are managing the lease up on a deal right next door to Hawthorne called the Edison. And so they also, I think, have 7 or 8 other deals in this immediate submarket. So one of the first calls we made when we got a phone call about the deal was to them, to go over our business plan, some of our assumptions and thinking on the deal. And Hawthorne's a deal that they've been tracking as a comp to some of their other assets they managed for a couple of years, and so we're very much aligned and on board with what we're going to do and what's possible here. So I think that's kind of our team. So I want to talk a little bit about the story behind this. As the marketing guy, I'm always interested. Reed's kind of the science, and I'm usually the art. So what's the story of this deal? How did we get it? We got a phone call the second week of December from a broker that we've got a really good relationship with and have closed 4 or 5 deals with. They had just signed a listing agreement, and their initial plan was to take this deal to market basically right now at NMHC, which is wrapping up in Orlando this week. But they called us and they said, we've got a deal I think you're going to be really interested in. Why don't you take a look? Kind of told us the story of it. We were able to underwrite it really quickly, made a few phone calls, talked to Cooper, talked to Roscoe, toured it, looked at comps, and realized that no, this was absolutely a deal that we would want. And we're able to work over the holidays to get a contract put together. And I think, during that time, I've also been able to corroborate a little bit of the story that we were in fact the only group that was given a shot at this and looking at it. So I take comfort in the fact we weren't, having to compete with anybody on it. And I know in talking with some of the other brokers that we know in town, even some of the other owners, that had this thing hit the market, it would have been just fiercely competitive and likely trades, maybe as much as $2.5 million more than what we're paying for it. So I feel good about that piece, and I think it's the type of deal in the location that is exactly what we want. The seller is a group out of New York that owns and operates deals across the country. They bought this in 2013, and they're selling it basically. They've executed their plan. Their investors is a big equity group, and they want to harvest some returns and also loans coming due. So after 7 years, they're going to do incredibly well on the deal. And are needing to exit it. And I think, took to the broker's recommendation that, we're a good group that does what we say we're going to do, and they can avoid the process of having to deal with 50 plus groups taking tours and answering questions and just the stress that comes along with trying to keep your property up, in tip-top condition for a full, beauty pageant that is a marketing process. So that's kind of the story in the background on why we were able to get it. So the asset itself, what do we like about it? I think number one, it's located in just an unbelievable area and pocket of Austin. Again, I'm gonna have Cooper talk through some of the details there, but in essence, we are 3 miles from downtown, and we're kind of squarely between downtown Austin and the airport. So as you think about the continued population growth that's happening in Austin, as the population projections continue to say, hey, we're going to double and we're adding 200 people a day, and this is going to be right in the middle of that development. It's also in probably the fastest developing corridor in the city, and again, Cooper will speak to some of that, but couldn't be more excited about the location, and being in a location like that, but having an opportunity that truly is sort of a down the fairway value add deal. It was built in 1987. So it's 80s vintage. It is 284 units. It's 12 and a half acres. It's got a very good amenity set. The seller has done a nice job of maintaining the asset. They've made some very nice and good upgrades to it. The leasing center was recently upgraded. The business center is nice. A few years ago, they built a standalone fitness center, about a 1,200 foot building that, instead of having the sort of pokey 2 treadmills and a weight stack, you've got a very nice fitness center that appeals to kind of the young demographic in the area. It's got a nice pool. They just recently renovated their dog park. Really the only amenity that we are going to go add is there's an old sand volleyball court that sits behind the fitness facility. And right now they've got a couple of beanbag kind of cornhole games there. And we're going to amenitize that a little bit more, make it a little bit more of a people park, and add some games and some seating and some lights. But from a value perspective, the vast majority of our CapEx dollars are going to go into the interiors, where we know we can push rents. We've got rent comp support. We've got Roscoe's support. We have a program that we know how to execute, working with THD and the materials that we've sourced from China, that we're just extremely confident in that. In addition to that, we know we're in an area that it's sort of hard to articulate, and Cooper will do a better job than I can, but things are happening here that frankly we just can't underwrite to. And things are trading, and things are moving so quickly that it's not out of the realm of possibilities that we get a knock on our door a couple of years from now and a developer wants to take this 12-acre site and put 3 or 4 story building here, which is exactly what just happened right next door at the Edison. None of those things are things we're counting on or expecting, but I think we're in that pocket of town where something like that could happen. And if you are local or in Austin, we'd love to kind of drive you around and show you what's happening with the Oracle campus, and with just the massive amount of development being planned all in and around it. So I think that's kind of, from my perspective, what I like about the deal and the story behind it. And again, it's a super clean, well-maintained asset. I guess I'll note, due diligence, we just completed that, and had our call yesterday, finished all the unit walks, and it came back very clean, sort of as we suspected. There's no major systems that need work. There's a few plumbing lines that have a few bellies that will go fix, but honestly, we haven't bought a deal yet that didn't have a few lines that had bellies. Just on, it's what you get on an 80s asset. But there were no major red flags, and I think it speaks to the level of care that the current owner's taken, and that the team on site has taken. And I think one of the things that's another benefit for us here is we intend, and the on-site team wants to stay, and we intend to keep them. And they've done a really, really nice job. The maintenance supervisor has been on site for like 7 years. The manager is outstanding. So it's a good team, and you can tell the care that they take, just if you're on site, and the kind of the cleanliness of the grounds and the quality of it. So if you pair, their team with our ability to execute value add with the location, we just feel like this is just an absolutely incredible opportunity, and we're super excited about it. So at this point, I'm going to turn over to Cooper and let him introduce himself a little bit and kind of talk about what's happening in Austin and what's happening on Riverside.
Andrew, do I come in all right? Can you hear me well?
Yep, loud and clear.
Well, I appreciate everybody being on the call. As Andrew said, my name's Cooper Drenner. I am also born and raised in Austin. I've lived there my entire life. You won't find many, Andrew and I've joked multiple times, especially in real estate, you're not going to find many opportunities where you have two people that are born and raised Austinites. My background, I grew up around real estate in this city. I went to UT with a finance degree and came out and worked directly for a developer in town called Endeavor Real Estate Group. I was on their retail team and helped manage a lot of the retail space across the city. And then for the last 9.5 years, I worked for the largest commercial title company. I helped to run our business development team for a company called Heritage Title. We did the vast majority we did about 90% of the commercial work here in the city. They did quite a bit of the institutional multifamily work across the state. Most of my clients were as institutional as it gets with Goldman Sachs down to local and on the groups. And so I've had the opportunity to underwrite and really get an interesting view of almost every multifamily group that's invested in our market. And one of the things that's attracted me about working with Andrew and Reed has just been, I think they have a unique take on it and a unique value set, but more than anything, the reputation that they had garnered in the marketplace as people that were going to do what they said they were going to do, and also had sort of a unique view on how to create value. And alpha is something that I really gravitated to. So it's been a joy to work on this first deal together. I also come at it from an interesting perspective, from a civic, sort of how I spent, in addition to my time at Heritage, I served on the executive council for the Real Estate Council of Austin for the last 6 years. That gave me a really interesting background, and still serve on that council of what's happening in the politics of our city, especially with infrastructure and how that affects our market. The other thing that I have served on is the Economic Development Council for Austin. Austin, for those of you that haven't lived here or just new to investing in the market, pre-2001, it wouldn't be a market you'd want to touch. It was the largest boom-bust market in the country. And the conversation that I'm having with capital across the country, when they start to underwrite and try and figure out why their investment thesis is telling them to be in Austin, is what changed. And I think that the exciting part for anybody that's investing money in our market is it's not just by happenstance. It's not the fact that we're sort of the blue dot in the red tomato soup of Texas, but it's starting in 2001, a group of private citizens got together and funded and put a plan in place along with the city's leadership to fully fund an economic development plan. Over the last 17 years, Austinites, private Austinites like Hawthorne, have funded over $170 million of an economic development effort. We're currently in the fourth phase of the program, and we still, what I think is really exciting when I get the question all the time is, why should I believe that Austin's not at the end of its rope, is we still are executing a plan that is played out exactly how we thought. Much of that plan includes candidly helping city leaders vision what the city should be. So for instance, our medical school that came in a couple of years ago, not 3 miles from this site, was visioned in the economic development plan. And much of the road infrastructure that is going on has been visioned in this economic development plan. We still have over $30 million to deploy over the next 3 years. So that, to me, that is a very exciting and comforting thing, that the growth and the rapid growth that we're seeing that candidly drew Oracle to Austin, and our economic development efforts were the reason that Oracle moved here in the first place and has helped them expand. Much of that growth is a plan that's still being played out. What I also think is interesting as you look at the mini market on the screen is road infrastructure is no doubt about it, our biggest Achilles heel right now. And it's something that we are rapidly addressing as a city. 4 years ago, we passed our largest road bond, a $700 million road bond. And it's not a road bond the way most people think of road bonds, or Texans, I guess, where we're just used to putting more lanes on the road. But what that $700 million went in, that passed by the vote of citizens, is to address major corridors in the road infrastructure and optimizing those roads in the major corridors in the heart of our city. No corridor in area is going to get any more funding and is any more impacted than East Riverside, the East Riverside Corridor Plan. The improvements are happening as we speak. A lot of that's optimizing light, optimizing turn lanes, and really creating the ability to handle and continue to handle increased density. What's also very exciting is that we are planning in November to put out a road bond that will dwarf what previously happened 4 years ago, and it will be the first time we have a multimodal plan. What's also exciting is this site ends up being about a block from what will be one of the major rail stops on the blue line, which would be the first line that will be impacted. And it'll either be bus, rapid transit, or light rail. And it will be the major conduit that gets people from the heart of downtown out to the airport. What's also interesting as you look at this city, in this area, the reason that growth will continue to happen is it's one of the few places in the city that there's been an agreement for density. And so you have an overlay plan that really dictates how things are allowed to grow, which for those of you that are aware of Austin, the fights over land use in Austin is absolutely a major part of what's going on. No project typifies that more than what you see on the screen. It's called Project Catalyst. It's 90 acres that it comprises 5 student housing projects in our city. This corridor in the 70s, for any of you that went to UT, well, you'll remember this was actually student housing. So this is 5 projects that are candidly competing with the Hawthorne for renters that will now go offline and will be over 3 million square feet of office and some very high-end multi and probably some condos. What's also exciting is the equity group, that's the institutional equity group that's a part of that project out of Denver, is continuing to acquire adjacent land. And so for those of you that know Austin and are familiar with the Domain, which is probably the most transformative sort of mini city within our market, this has the prospect to be very much the same thing. If you'll go to the slide that shows sort of an overview of like projects in the market, you'll see a lot of things here. I want to draw your eye to a few things. The retailing guy in me will never change, but the idea that H-E-B actually bought 2 of the empty grocery boxes and took a store offline so they could build a massive H-E-B plus here. H-E-B is obviously the dominant grocer in Texas, maybe the dominant grocer in the country. They built a massive store that really will allow for infrastructure here. H-E-B also is going to drive all the retail that serves our renters around it. Endeavor, which is probably the largest mixed-use developer in the city, just acquired a site directly adjacent to that H-E-B. It's just under 12 acres that is zoned to handle another 1 million square feet of office, multi-condo retail. A few other things to draw your eye to. You'll see Oracle on the screen. Oracle delivered a 400,000 square foot Class A office building that houses just their employees. Oracle's currently under construction to build phase 2 and is acquiring some C-class multi in the area with hopes of building phase 3. So when you look out and you zoom out, you can clearly see what could be 2 or 3 million square feet of just office alone. But what's also exciting is you're taking off the market many of the sort of C-class multi that has sort of been representative of what was built in the 70s and 80s here, and really positions Hawthorne really dramatically to benefit from all those things. One test case that comes to mind that I think would be interesting for people on the call, a multifamily developer here that develops across the country called Cypress developed a deal in the area called the Pearl that was really, at the time, almost 9 years ago, the nicest, newest deal in the market. It was a garden-style deal. It was beautiful, right on the edge of Oracle's campus. They sold it in a very hotly competitive process to Inland out of Dallas, which is about as institutional and core low return money as it gets. Just 2 years ago, Cypress has now bought back their own asset and are tearing down that asset to build a podium. So think much higher end, much higher, more dense product. So that just shows in such a short time how this market is not only improving, but rapidly changing and envisioning towards much better. Andrew, did I cover everything? Is there anything else that you'd like me to touch on as we sort of look at the market in general here?
No, I think that covers it. And obviously that we have a lot more slides in the deck on, just stats around Austin and population growth. I mean, I think, one of the things that we look at it on this deal, kind of when you look at the area, he mentioned there's, that Project Catalyst is 18 months to 2 years from turning dirt. They're already not renewing leases. I think that's about 650 units that'll come offline. I think the other thing about this area, and as it becomes and continues to become sort of a work, play, live corridor, is just sort of the demographic that lives in this area. And it's, I think in the zip code, it's 70% of the renters are 30 and under. And I think that kind of speaks another competitive advantage we've got at Hawthorne is the floor plans and kind of the square footage. We're like 680 plus feet on average, which is pretty small. And it's like 70% one bedroom. And if this was located in like Lake Creek on our last deal at the Baxter, that'd be a concern. But given that this is largely, singles and couples with no kids and, they're there with their dog and they're working professionals, I think it positions us really well to capitalize on the demographic that is in the market and that will continue to move to the market, to fill all of these jobs that are going to be going into this, to all the office that's being developed. So definitely excited. I think you did a good job covering it there, Cooper. So I'm gonna have Reed walk through kind of the business plan. As he does that, just another quick reminder, if you have questions, start sending those over. Feel free to send those over. Email them to andrew@wildhorncap.com. And as Reed gets through this here in the next few minutes, we'll have some time to answer questions.
Yeah, thanks a lot, Andrew. Hopefully coming through loud and clear for everyone. Great summary there, Cooper. And I just want to add one different perspective given for those people who don't know who I am on this call. Clearly, I have a really different Southern accent to most Texans. I'm from down under, and I've moved to America back in 2012. And one of the advantages that I think I have being an international investor and bringing some international folks into the United States is that America has such an incredible diversification in the opportunity to from not only multifamily, where multifamily doesn't even exist in Australia because of certain zoning and taxation laws, but also the access to really incredible financing. So I definitely want to hit on that. And given the international perspective, where I come from a country where cap rates are sub 3% and cash flow doesn't exist and multifamily doesn't exist. Seeing the transition of a city like Austin, Texas over the last 20 years and the sort of really conscious decision to invest in a city to transition it to now we're all reaping the rewards and bearing the fruit is really incredible. So that's just a little bit of a snippet of why I think Austin and investing in the United States has the best of both worlds, capital appreciation, but also cash flow to keep investors fed along the way. So enough being said about the high market, and why we love Austin. And so what I'm going to talk about today is a couple of things on really why we like this deal, and back to a little bit of how you underwrite this deal with all the exterior stuff that's going on, the oracles and Project Catalyst and different aspects coming offline and 600 units going offline, and so. How do you underwrite to it is the real question. Well, the simple answer is just underwrite it to like a normal value-add multifamily, because there is value to be added here. There's all the sort of the extras that we could add to it, meaning outside factors, but that's only going to be the gravy on top. So right now, we're really going to be focused on what I'm going to cover today is our underwriting. We're going to talk a little bit about the rent growth, how we are comparing our rental premiums to other rental premiums in the market. What are the current renovation plans that have been done on site and how we're going to capitalize on those. We're going to look at the capital expenditure plan and what that entails. And we'll talk about efficiency of scale, given we have 1,800 or 1,700 units in and around San Antonio and Austin. And we're going to talk a little bit about the debt financing, and finally we'll cover the sensitivity analysis and a few other little bits and pieces on the underwriting. So the big thing of the conservatism of underwriting is really about, we pride ourselves on what we come in and want to achieve. And we make sure that we are buying something that there is a proven value-add strategy in place. And right now there are currently 137, 138 units, which are of what we like to call a standard unit type. And these are the vintage units that really haven't been touched since the inception of this deal back in the mid-1980s. We also have a contemporary type of unit, and there's two modern levels of upgrades. The modern 2 is the current ownership's full renovation, and you can see that in the bottom left-hand corner of your screen, and that is stainless steel appliances, granite countertops, and they're getting about a $200 rental premium over the classic units. In our underwriting, we are definitely going to go and touch all of these 138 units, given what Cooper and Andrew said about stuff coming offline. Our goal is to really be the best Class B multifamily in this area, and we want to offer the best type of product that we can. So we're really focused on turning those 38 units in the next 12 to 18 months. And we're going to take these to a higher level of standard of upgrade compared to what the current ownership has done. And we're going to include, obviously, there's going to be granite countertops and backsplashes and stainless steel, but we're also going to go and include undermount sinks. We're going to include Nest thermostats. We're going to include, connectivity to the internet and internet packages that, really entice that millennial generation. We're going to look at keyless door hardware entry locks, which is, again, what other Class A brand new construction is coming online. But we're only underwriting those rental premiums, given that the market and what the current ownership has tested, they're getting over $200 rental pops. We're only doing $175 rental pops premiums for these particular units. So still maintaining a very, what I believe, a conservative level of underwriting moving forward. And then for the next level of upgrade, we're going to look at what's called a contemporary level. And those contemporary level of upgrades will be what we'll call the new standard level of upgrade. And they are only going to have a very light touch. We're only going to expect a $65 rental premium, but they're only going to have resurfaced countertops, black appliances, resurface the cabinets, and they're going to be the lowest level package that we offer into the market. And for those product, we're going to expect a $65 rental premium. The final upgrade we'll do is take the Modern 1 units, which are similar. We'll call them a espresso cabinet. You can see here in the picture here, there's like an espresso brown cabinet. We're going to keep all that and much more. We're going to replace the new vinyl, put in some new light fixtures, resurface the counters, also not resurface, put granite in the counters, lower the countertop, the bar, breakfast bar to be a complete one surface. And for that, we're going to look to get about $100 rental premium. Again, all of this is in mind that we're going to go out and execute this plan over the next 24 months with a slow and steady occupancy level to maintain the occupancy, because we know that we want to give heads in beds, and heads in beds means that we get revenue. So overall, I think that we've been being really conservative with our underwriting. And if we look at the current on page, I think it's 38 of the plan, we're underwriting this asset to be well below what other comps are in the market. And even now, when we can see that we are currently at a bit over just under $1,100 in actual rents for the entire portfolio, the entire asset, where other comps for 1980s vintage or older are getting nearly $1,300. So even there is already a $200 rental bump or rental gap between Hawthorne and the other units in the market. And so when we're going to come and continue to do the renovations and bring a better product to the market, we are very much expect, and we've only underwritten to a $175 rental premium. I believe in wholeheartedly that we could achieve better than that. But even in the future, when these other assets are going to continue to increase in rental value, so will we. And we will still not be at the top end of the market, which gives me a lot of satisfaction. In terms of the overall efficiencies of scale, I want to talk a little bit about what we have done, and Andrew hit a little bit on earlier about the direct sourcing from China and having our very strategic partner of THD, who's worked in and around our portfolio. They've done 7 deals with us to date. So really, two things we can efficiency as a scale is obviously we've got a lot of bulk ordering. So we direct source flooring, countertops, granite countertops that are lighting, and different door hardware that we source directly from China, and we can get a better premium on that. So we can deck out a unit for about $600 or $700 fully renovated with a granite countertop, so from a granite countertop point of view. And that to me is really important, because when you're going up against other product, Class A product, being efficient on your cost is really, really important. So we're planning to spend about $2.8 million at this asset, and we're expecting about a 20 to 23% ROI on our investment into the interior renovations. And because a majority of that $2.8 million will be spent on the interiors. As Andrew mentioned before, and as you can see from the pictures in this presentation, this asset's very clean. We don't have to do a lot to the exterior. What we will be doing to the exterior will be doing a lot of just touch-up work, adding some new FF&E to the pool, adding some new FF&E to the gym, because, as Andrew said, the millennials are in this area. More than 60% of the renter demographic at this asset are less than 30. They want a gym. So we're going to go add those little touches to it, but we're really focused on the interior renovations. And for those people out there, a good rule of thumb is if you get north of a 15% ROI on your investment into a unit in comparison to its rental premium, then you're doing pretty well. For our rental premiums, we're looking at about a 20 to 23% ROI on the investment. So I think overall, and I believe that's still to be conservative, I think we're going to do very, very well, given our efficiencies of scale, given the fact that we have a great sourcing product directly from China, given our relationships with our general contractor, and we've really dialed in what our costs are. The other thing is that we can also achieve our rental renovations on a bit more of a tighter budget because the square footage is on the smaller side. As Andrew mentioned before, the square footage, if it was out in an outer-lying suburb, it may have been an issue, but for here in this demographic, that size of square footage is not really an issue. And the two major capital expenditure items are flooring and paint, and they can be, we've obviously got smaller units, so the smaller units means we can spend less, and the average spend across this asset will be about $6,500 per unit to bring all these units up to what we are conservatively saying $115 rental premium on average across all unit types. So in terms of how we're positioned in the market, you can see that from a rental premium point of view, we're still maintaining a healthy gap between the top end, higher, above 1990s build, newer construction, but even within our own subcategory of less than 1980s or 1990s built, we're still maintaining a healthy gap between the upper end of the market and where we project to be in 2 years' time. In terms of the sales comps, we have definitely picked this asset up at about a 7.5% discount when you compare it to other 1980s assets in the market on a price per door metric. And you can see that from post or post 2001 built, the newer build, that they're fetching in around $200,000. I do know that we've got two other sales comps that have recently hit the market in the month of January around NMHC. And one is called Aspect by Cortland, and it's a 2000 vintage, which is less than a mile down the road from Hawthorne. And whispers of that, it's a similar look to Hawthorne. There looks like it's going to trade north of 190K a door. Also Edison, which is the property right on the corner of East Riverside Parkway, which is a neighbour to Hawthorne. It is a new build, and it's just finished lease up, and it's just hit the market, and it's probably going to trade for about 270K a door. So with all that being said, you can really see that there's a lot of growth going on in the market. There's a lot of activity in terms of buyership. In terms of the actual model itself, and what we'll go a little bit back into, some of the things that I like about this deal. We've hit on the capital expenditure plan. We're going to talk a little bit about the NOI growth. And it really overall, for what I like about how we've underwritten this deal, we've underwritten it to historically just a typical value add, with the upside being there in the future potential there when the growth of the project catalyst comes online. But overall, I like to look at over a life of a deal. If you're particularly a 5-year deal, and a lot of people who are on this call probably look at other deals and look at other operators, if you look at the NOI growth over a hold, if you're south of 50% NOI growth over a 5-year hold, that's pretty conservative and pretty moderate growth. On this particular deal, the delta between the current NOI and where we're going to exit this thing in 5 years' time is about a 41% 5-year growth, which is a little bit over 8% year on year. If you ever see anything over 50 or north of 50%, unless it's half occupied, I would be word of caution that anything over 50% can be a little bit aggressive. So we're still showing really great returns to investors with a moderately 40-41% growth over 5 years. In terms of the sensitivity analysis, I think this is a really good snapshot of the potential that we talk about how do you underwrite to an exit if someone comes along and offers us silly money for it. Well, we're projecting to exit at a 4.6 cap, which is shown there in blue. And then obviously you can see if we do 30 basis points better, what the Class B returns will increase to if that was to occur. Also, conversely, if the market is to soften, we also have a varying scale there, and it goes up 4.9, 5.2, all the way up to 5.8%. The real reason we give these sensitivity analysis is to show investors the capital preservation is first and foremost, and that we do everything in our power to make sure that we're looking at every single scenario, because we don't have a crystal ball. And all we do is something that we're projecting today, that in 5 years' time we're going to exit, and everyone's going to make some money and move on down the line. In terms of the sensitivity to GPR stabilization come year 3 and how it varies to the occupancy, you can see here that this is a classic table. We show both these tables to those people who have been on these calls in the past. And this really is an indication that once we hit stabilization in year 3, if for whatever reason we are off by a GPR of 10% or a varying scale, in the worst case scenario, we're off by 10%, and our asset is, has an occupancy, an average of 20% in that particular year, then the average cash on cash return over 5 years is projected in the worst case scenario to be still a 1.27% cash on cash, which are now indicating that, again, you're not going to lose your money on this deal. Conversely, if things go really, really well and we overperform and we get better occupancy, then you can see the other end of the scale where your cash on cash return to Class B investors will improve. So overall, we do like to show investors as much sensitivity as we possibly can. The last thing I want to cover before we get into questions is the debt and the different types of debt that we have looked at and what we've come to a conclusion on. So we have chosen in this deal what we call a bank financing debt. It's going to be non-recourse. We have got terms in and around 72 to 74% LTV. This will be non-recourse. It'll be 5 years interest only. It will be a variable interest rate. However, we are going to buy a cap on that interest rate. And the reason we're doing that is because we want the flexibility of exit. We can either exit in 3 years to someone who wants to come and pay us a lot of money for it, or we can continue to hold and transfer over into a perm debt. The other thing that we like to do when we're looking at non-recourse debt is look at what is our leverage for the entire loan to cost. And we like to make sure that we're raising our capital expenditure from investors. Now, we could go out and get an 85% loan to cost loan on this deal, but we believe that wholeheartedly that too much leverage coming into the next 5 to 10 years can be a risk. And so we don't want to overburden the asset with too much leverage. Hence why we're still raising capital expenditure from investors. And it means that we can be in control of our own capital. And given if there happens to be a slowdown in the market, we can also pause on renovations at the same time because it is our capital. So really, the overarching thing is what I like about this deal is obviously that we've hit an incredible pocket in the market. We've got this deal off market. The barriers to entry into the Austin market, which is one thing that the boys didn't really mention, is just how difficult it is to get things approved in and around Austin. So it really has turned into a global city. And also some of the other things itself about the deal, it still pencils at a traditional value add multifamily at really, really great returns, given it's in the belly of the beast around some incredible infrastructure that's going on in the next 5 to 10 years. And we've still remained conservative with our rental premiums in terms of how we compare to the other assets in the market. And we're also getting some really incredible non-recourse, low leverage debt on this asset. So really excited to, all those things tick the box from an underwriting point of view, from a deal point of view. And I'm really excited to have this asset join our portfolio in the next coming months. Andrew, I will now hand it over to questions.
Yeah, well, and I think maybe before we do that, if you want to pull up the kind of equity return profile, we can kind of talk through some of the structure and kind of how that works. As a few questions have come in about that, and it's probably just, we can speak to that here. So I guess, and I'll kind of walk through this, from a structure standpoint. We offer A shares and B shares of equity here. A shares, you get a straight 10% return. It is paid current and immediate, and is kind of you can almost look at a sort of a real estate bond, if you will. You're going to get paid first, and the cash flow from the property will service this. because you're positioned in the equity stack, you don't participate in the upside, but it's a very, safe 10%, and you also participate in the tax benefits as an equity investor. And then the B investors sit behind the A, and they get a 7% preferred return. And you can see the projections here. We think anything that we don't distribute on an ongoing basis up to the 7 will accrue. On this particular deal, we don't expect we'll hit that 7%, and we'll have a catch up which will occur in year 5. But you're positioned to capitalize on more of the growth that's expected, and we think this would be close to a 2x your money in 5 years, a 1.9, with what we think are really attractive returns. So as you kind of mull over your interest level and investment, kind of looking through those two options, that's kind of how the structure is set up, and kind of to meet the different sort of risk appetites that different investors have on the deal. So I think that's the structure. I do want to touch really briefly on timeline, and then we'll start firing off some of these questions. So timeline, from today, we will have our online portal live next week, where we'll have this deck and some of the materials we've shown tonight. We'll put our PPM up there as well, that you can download and review and talk that through with your attorney if need be. What we need, PPM signed by the middle of the month on the 13th or so of February, and funds and all the instructions we posted on the portal by the end of February. The current plan is for us to close on this property about the 12th of March. Might close it, the week prior to that. So we need all funds by the end of the month of February, as you're kind of plotting and considering this investment. And as sort of normal course of business, it's always kind of first come, first serve. I know that there's been a tremendous amount of interest on our end on the A shares specifically, and frankly, the B is flying as well. There's just, I think people see the path and they believe in kind of what we've presented here with the story of Austin. So that's kind of a timeline. And from there, some questions. And I know that there's always questions. Reed, do you want to kind of touch on kind of general fee structure has come through, and it's something that we kind of talk through what fees are charged, and I'll start filtering through some of these other questions.
Yeah, that's easy done. So the typical industry standard fee, we're charging a 2% syndication fee on the front end. We charge a 2% asset management fee on all gross potential rent, and that's paid out quarterly, and that's paid out before in the Class B investors. And the other fee we get is a 5% construction management fee on all capital expenditure, and that's baked into the CapEx budget. And there's no exit fees, and we're pretty much aligned with the industry in terms of what fees we charge.
All right, let's see. A couple of questions, kind of DD. Anything come up on due diligence? I know, Reed, you and I were talking yesterday about some air conditioners and kind of the condition of those. What's our plan, and what are the kind of big items coming out of DD that we are prepared and planning for expenditures on?
Yeah, so a lot of I'm sure people have walked around site and seen some of the older vintage HVACs. What we do on every takeover is we do a repairs maintenance plan, which will go in and we'll blow out all the lines, we'll test the units, see what needs to be replaced at that point. But we've budgeted for about a 15% complete renewal of old HVACs in the first year. And Roscoe Property Management is aware that in come year 2, year 3, year 4, that they're going to have to be prepared to replace anywhere between 5 to 10% every year. So we've definitely captured that in our renovation budget. So we're looking at about $80,000 in year 1 of HVAC replacements. That's if they go out. Now, we could limp these things along for a little bit longer, but it's better to have that money on hand, and get them replaced. So come the heat of the Texas summer, tenants aren't getting having the HVACs being turned off from just being too old. So yeah.
Okay. Debt, a couple of questions here about, more details on the debt. So we've got our kind of down to our final three lenders, kind of got their term sheets. And I think what we're really excited about is that all of the terms kind of referenced in the deck, we're going to be able to beat. Frankly, we're turning away some proceed dollars. A couple of groups are wanting to push, to Reed's point, upwards of 80%. But we will probably wind up with an interest rate of somewhere starting at 4.1 to 4.2%, which is quite a bit better than we expected. We're negotiating some on the floors, meaning that if LIBOR, which is what these loans are based on, continues to drop, that we won't have a cap as far as how much that can drop. And obviously, the lender requires a rate cap on the upside if rates were to increase. The one nice thing, kind of indicative, that shows that no one's really expecting rates to go up, and one of the reasons capital continues to flow into the market, rate caps are incredibly cheap right now. So that's something that we will kind of be looking at over the next week as we finalize the lender and the exact terms of the product. But that's kind of how the loan products work that we're evaluating.
Got another question here about how's the variable rate underwritten to. We've just done a 10 basis points a year increase year on year, and that's how it's and that was starting at a 4.5%. So we already know we're beating that by the rates we're getting. So come year 5, this deal from a model point of view, essentially it has an interest rate of 5%, is how it's been modeled out. So we could argue to the cows come home if that's not too conservative, but that's why we've got a rate cap. So the rate cap will be at around 5% anyway.
Okay. So talk about the decision for bridge debt here versus agency in any other product. I mean, we've certainly looked at all of those, and we've done lots of agency in the past. It's something that we look at each one, and I think Reed touched on it a bit earlier. Wanting to have some flexibility here to create the maximum upside on an exit, and given what's happening with the development in the market, we want to be able to strike if 4 years from now somebody knocks on our door to be able to sell. Bridge debt typically has the easiest exit scenarios. And feel like for this asset and the location, it's kind of the right strategic tool for us to use on this asset.
Someone has a question here about the GP LP split. So it's still a 70-30 split to Class B, Class and GP. So that means that per this diagram here, you can see that come any profits after sale, Class B investors get 70% of those profits, and us as the GP get 30%. And Class A don't get any because they're not participating. But from a taxation point of view, throughout the hold, Class A investors do have ownership in the deal, so they can get the flow-through benefits from depreciation. And we will, for those, I know a question will come up. Yes, we do cost segregation, and we typically execute that within 3 to 6 months of owning any asset. So we'll be buying this asset in 2020. Come the end of 2020, all your K1s will have a depreciation line on there that we will capture through cost segregation.
Yeah. Could you pull up the CapEx slide, Reed? And there's some questions just in general about what are we spending per unit if you kind of average it out across. And I'm not sure if this
was I mentioned
as you were talking.
I mentioned it a little bit earlier. The average, I think it was like 6,500 or something. If we quickly do the math again, it's 1.5 million, just give or take, divided by 240 units we're doing it. So $6,300 a door. And the major cost being flooring and paint. And because of these are the smaller units, and because of our direct sourcing from China, we can get very, very tight on this number. And we're very, very confident that, and given that THD will be doing the renovations and what we've priced out across our other 7 assets, we're very confident that on a price per door, that's easily achieved.
Yep. Question here about kind of the cash flow for Class B and kind of where the exit cap rate comes from and kind of how all that works together. I think I'll take that. So the Class B, the kind of projection for cash on cash over the life of the deal here is about 4%. And that's just a function of us paying Austin rates, and to get into a location like this, we don't project it's going to hit that 7% hurdle. But however, you're going to participate in the upside, and we think that the upside potential here is going to be very lucrative and pretty incredible. We do have it as the exit cap rate kind of a 4.6, and that's obviously where no one's got a crystal ball. But I think spending a lot of time talking with brokers and people like Cooper and just looking and leveraging what's happening over there, that is certainly quite a bit higher than where market is today. And we think, with the growth prospects of Catalyst and the continued development of Oracle and all the office and everything happening in this pocket, that it very likely will be quite a bit lower than that. If this continues to develop like the plans, that Austin has for it to go to. And so that's kind of how we've come up with our conclusion there.
Yep. We've got a question here about building culture in this community. In terms of any culture that we build, there's a lot of things that Roscoe does. We're very proud of what they do. The regional manager who currently manages or oversees our current Austin assets has done an extremely good job. On the other two, we're coming in, changing the demographic, changing the renter profile, and being able to achieve that on both our other assets within a pretty short space of time. In terms of community feel, there's obviously, I think, monthly and quarterly events that they host. Wind Down Wednesdays is, as I know, it's a big famous one that we host across all of our assets, that people come in and get to know each other and get to know the team. And to Andrew's point before, we want to keep pretty much the entire team that's already there in place. So from a renter's perspective, they're seeing the same people day in, day out, and we don't want to have to disturb that. And we see that's pretty successful. And we know that for everyone from the maintenance all the way through to the property manager are Class A type of folks, and they really, really love this asset. So they're going to continue to drive that and push that needle forward in terms of building community.
Question here about accreditation and distribution. So this is going to be a 506B offering, but it's going to be only open to accredited investors. As you fill out the subscription paperwork, it'll ask if you're accredited. You will not have to supply any accreditation documents as a 506B, but you do need to be accredited, so no non-accredited investors. And the distributions, we make distributions on a quarterly basis. So both Class A and Class B will receive quarterly distributions. And to Reed's point, those will coincide with quarterly communications about the financial performance. And so we'll send a monthly, what I call a qualitative update, just kind of performance on site and what's happening. And then each quarter we'll get a distribution and sort of the full financial view of what's happening, rent roll, T12, everything that you might want to look through there. Question here about co-invest from the general partners. I think the general partners in this deal, we will have well north of $1 million invested, as we believe in this deal, and are excited to participate.
I've got a question here for waterfall. There is no waterfall. It's 70-30 all the way through. So if the deal, we knock it out of the park, if someone comes and buys it off us for a silly amount, then it's a straight 70-30. So that answers that question from Scott, I think it is.
Yeah, and then I think I know it's 8:00 here. I got one more here, and anything else that continues to come in, we will follow up and get these posted onto the portal. There's a Q&A section, but a question about both in insurance and taxes, and how do we kind of plan for that? So, we've got on the tax side, we work with a consultant, Morrison and Head, based in Austin, and sit down, talk to them about our plans. What we think the adjustment is going to be. From a purchase price times the mill rate. And, in this case, they've said, hey, I think year one, you're looking at, as low as 90 to as high as 92%. In year two, 95 to 98% of our purchase price. So we leverage their kind of expertise and background a lot. And again, I've plugged the more penal of their assumptions into our model to be conservative. On the insurance side, similarly, we've got a great relationship with our insurance partner, and they're very on top of what's happening in the market. And obviously the premiums have been going up, and we do the best we can to account for those increases, and are in constant communication with kind of what will be required by the lender and kind of what the market is. So we do our best to surround ourselves with kind of the industry experts and consultants across the board, to make sure we're accounting for all the different variables and components that go into operating these deals. So I think with that, be respectful of people's time. Again, I haven't seen anything come through here just yet. We really appreciate y'all's time. We will certainly send a link, probably either later tonight or likely tomorrow, to this if anybody wants to go back through it. And we will send communications once we have the investor portal live, up and running, and you can course through all this and start to firm up commitments and review PPMs. So appreciate everybody's time. Really, really glad you're interested. We're super excited about this deal and what's happening in this pocket of Austin, and look forward to connecting with everybody soon.
Thanks, guys.